Today we're going to talk about investing in startups. 100x, even 1000x on your invested money is because it's simply very encouraging. So that's very important. Hi, my name is Andrew, the founder of 8 Figures, and today we're going to talk about investing in startups. Why you might want to add startup exposure to your portfolio and how to get started. I've been investing into startups for over a decade, both professionally at Goldman Sachs and personally as an angel investor. So why you might want to add startup exposure to your portfolio? And the first reason is, of course, the outsized return that you can make on startup investing. 100x, even 1000x on your invested money is not that rare, actually. You can hardly make this return investing in stocks or even crypto these days. Startups still offer you that opportunity, of course, if you pick the company right. Second reason is diversification. Startups, especially if you invest at the early stage, seed, pre-seed level, are much less correlated with the rest of the market because the return is mostly driven by the startup itself, how well they sell, how well they find product market fit, how quickly they get to market and grow, rather than overall market dynamics, interest rate, and so on. Of course, market impacts how startups can raise money. As we can see, when the rates went down, the market was flooded with cheap money, and a lot of this money went into startups. And the opposite is true. When the rates went up, the market dried up for startup funding, and a lot of startups struggled for that reason. But those companies that can actually make money rather than burn without any revenue, they actually sustained and grew well, and eventually investors made a lot of return on these investments. And the third reason why you might want to add startups into your investment portfolio is because it's simply very encouraging. You work together with very smart people. You can see how founders build something innovative. You can learn more about particular industries. So it's, if you think about it, when you invest into a public company, you can only read that much research or news coming out of the business, maybe listen to management on the quarterly calls, but that's it. You don't see from the inside how the business is built, how metrics are growing, how founders are thinking. All of that is available when you invest into startups. And if you think about the potential returns, well, let's say you allocate 10% of your capital of your investment portfolio to invest into startups. And let's say you invested into 10 startups, right? 1% of your capital into each startup, which is, kind of reasonable diversification. Of course, if you can diversify even more to 20 names, that's even better, but 10 is a good start. And let's say at least one of these investments actually made a home run, and let's say grew 100x. Well, then this 1% investment all of a sudden doubles your overall capital, and in an uncorrelated way to the rest of your portfolio. So that's very important. By adding that uncorrelated exposure, you really improve your portfolio metrics, risk-return metrics. So how to get started? Well, the first and the easiest way to get started investing in startups is to look at crowdfunding platforms like AngelList or Republic.com, where you can really get started with relatively small checks, down to $1,000, and still get some startup exposure. But the downside of these crowdfunding resources is that the best deals might not come there, might not be listed there, so you only have relatively narrow selection of what you can invest into. The second way to get started investing into startups is to invest into venture capital funds. By investing into venture capital funds, you can actually see how they work, how they invest, how they source deals, how they underwrite deals. So you can learn a lot. And it's probably worth recording a separate video on how to choose the right venture fund, but try to prioritize those that give you access to co-investment opportunities. So you can invest not only into the fund itself and become an LP, limited partner of the fund, but you could also invest directly alongside the fund into particular names. This way you get closer to the business, closer to the founder, you are listed directly on the cap table, and you can learn much more rather than just being a passive investor behind the fund. And third way to get started investing into startups, of course, is to invest directly. And for that, you need a bit of sourcing. You need to find those founders, find those companies, underwrite them by yourself, and make those decisions. The best way to find those investment opportunities is to go to conferences, to startup pitch competitions. But just to keep in mind, if you're just getting started with investing into startups, a lot of those investments you will have to write off. So you gotta be ready for that, because a lot of startups, they just go bust. I mean, it's hard to get something out of nothing, hard to grow the business from 0 to 1, extremely hard. So just to summarize, consider investing into startups if you wanna increase your return of your portfolio, if you wanna improve diversification by adding uncorrelated exposure, and if you wanna learn something new from incredible founders and industries as well. And to get started, this is really easy. Consider crowdfunding platforms, consider investing into venture capital funds, or consider going into events where startups present their business and invest directly. In our future videos, we will unpack how to underwrite startup investments, how to choose the best venture capital funds, and generally how to think about startup investing in the context of your portfolio. Thanks a lot for watching. Don't forget to subscribe.